Hello, welcome to hands-on-erp.com. This is Hassan Mir. In this session, I will talk about multiple organizations access control overview. Let's do a quick recap of all the important structures we have in Oracle applications. Details are covered in General Ledger module section. Business events are taking place in a company. For example, a company is buying items, company is selling items, and so on. All these business events results into accounting entries. Either accounting entries are manually entered in the system or automatically generated by different modules. And it is due to these accounting entries, all the account numbers have correct balances, and these are the balances that are represented on the financial statements, and that's how the health of the company could be judged. By looking at the financial statement, one could tell what's going on in a company. So generation of accounting entries are an important part of any accounting software, including Oracle Financials, which is a suite within Oracle eBusiness Suite. Now, coming back to the chart of account structure discussion, in a typical accounting software, you will simply debit a certain account and credit maybe another account. Account numbers are representing different items. For example, office supplies could be represented by account 5000, cash could be represented by account 1000. So debiting account 5000 means you're increasing your office supplies expense. Crediting account number 1000 means you are reducing your cash by certain dollars. So in a typical accounting software, you will debit certain account and credit certain account. But in ERP software like Oracle applications, you can capture more dimensions besides just capturing the natural account value. For example, you can say, okay, we purchased $100 worth of office supplies, but which cost center is responsible for capturing this cost? So you can say, okay, cost center 100 is associated with this expense. You can have another dimension capturing the projects going on in the company. You can have yet another dimension capturing physical location of the office that was associated with this debit, and so on. So you can have multiple segments in your chart of account structure capturing different dimensions of the business that was associated with this transaction. Sole purpose of capturing different dimensions is reporting, so that you can report on these dimensions. If somebody asks you, okay, what was the total expense incurred by project A? If you're capturing the project in your accounting entries, then you could answer this question. Otherwise, you cannot answer this question. If somebody asks you, what was the total cash spent on project A by department 1? If you have a department segment in your chart of account structure, and if you have a project segment in your chart of account structure, then you could answer this query. Otherwise, no. So that is the whole idea of capturing different dimensions, so that you could do reporting on those dimensions. So at least two dimensions are mandatory in Oracle applications. You have to create a balancing segment, usually called company segment. You could call it anything. And you have to have natural account segment, usually called account. Without the natural account segment, accounting is meaningless. You have to have account numbers captured in your debit and credits, and these account numbers are representing different categories. Let's say office supplies, cash, and maybe buildings, and maybe cars, etc. And company segment captures the company that is involved in the transaction. So you could have multiple companies in the system, and you can enter data for different companies within the same ledger, which is a container of journal entries. Even if you have only one company and you are not going to enter data for any other company, still you have to create this balancing segment, usually called company, and you will always enter your company number, maybe 01, in that segment. In certain cases in Oracle applications, cost center is mandatory if you're using fixed assets module known as assets, Oracle assets, and if you're using projects module. So in those cases, cost center is mandatory, otherwise it's not. So you can have system up and running with two segments, but usually companies would have average 6 to 8 segments in their chart of account structure. There is a term balancing segment values often used in the world of Oracle applications. So let's try to understand this term. We have already talked about that in a chart of account structure there has to have a segment called balancing segment, usually named as company segment, and the values going into this balancing segment are called balancing segment values. And usually these will be the company numbers that are part of your enterprise. They may not have to be legal companies, they could be simply management companies, but these are the companies for which you are keeping the books. When you're entering a journal, it has to be for one of these companies. Now there is a term called legal entity. Let's try to understand that term. Legal entity is not the same thing as a balancing segment value or the company number. In short, a legal entity is a company that is registered with the government as a taxpayer company. So it is a legal company in the eyes of the government and it has its own tax number. Having said that, a legal entity may be represented by one company or balancing segment value in Oracle, like in this example in scenario 1, company 3, balancing segment value 3 is one legal entity and balancing segment values 1 and 2 are one legal entity together. So in the eyes of government, balancing segment values 1 and 2 is one company, but for our management purposes we are keeping their books separately, so we have represented them as two different companies. Or it could be a case that you have multiple companies in your enterprise for which you want to keep books, but in the eyes of the government the whole ledger or the whole container that is containing journals is one legal entity. So you will associate all these balancing segment values with one legal entity. So the bottom line is that there could be one-to-one relationship between balancing segment values and legal entities, or there could be many-to-one relationship. It all depends on the scenario. So what is the significance of legal entity in Oracle? It owns your bank setup, your taxation setup, and all the transactions that are generated by the subledgers like payables and receivables. They have legal entity stamp on it. So all these operating units that I will talk about are serving one or the other legal entity. So legal entities own transactions that are generated from the subledgers, they own bank setups, and they own taxation setup. Now there's a term called ledger. It used to be referred to as set of books in previous versions of Oracle applications. The most popular version was 11i, and then in release 12 the term is now called ledger. So ledger is simply a container holding journals in it, and the data in the GL module is segregated by the ledgers. So journals going in ledger 1 are not visible from ledger 2, and similarly journals going in ledger 2 are not visible in ledger 3. So one ledger could still contain data for more than one companies, as we have discussed earlier. Why to create a separate ledger? This is a separate discussion and I have covered that in detail in journal ledger section. If you have 5 companies to implement, you have to make a decision whether to put them in one ledger or different ledgers, and there is a certain criteria that you have to follow to make that decision. So a ledger will have certain chart of account structure associated with it, meaning journals going in that ledger will always be entered in that chart of account structure. So if your chart of account structure has 3 segments, then all the journal entries that are going in that ledger will have to follow the 3 segment structure. So the first segment would be company, second would be account number, third would be, let's say, cost center. So all the debit and all the credits will have to follow the same structure when it comes to entering journals in the system, or even that's true for journals that are automatically generated. And all the journals will be in a certain functional currency. You can enter journals in foreign currency, but they will be converted into, the amounts will be converted into functional currency at the time of journal entry based on certain exchange rate that you'll provide. So each ledger has certain functional currency married to it. Each ledger has a certain calendar attached to it. A calendar will have X number of periods in a year, usually 12 or 13, one period being a special adjustment period. that calendar could be a quarterly calendar. It could even be 365 days calendar with having 365 periods in that calendar. So the bottom line is that one calendar has to be associated with the ledger. You have to open a period, you enter journals, you close the period, and you move on to the next period, and so on. And accounting convention is attached to the ledger, and it doesn't really impact your operations within the GL module, but all the accounting entries that are generated from the subledgers will be generated based on this convention that is attached to the ledger. For example, two most popular conventions are accruals and cash basis accounting. So if you have associated convention with the ledger, then all the subledgers that are attached to this ledger will be generating and sending accounting based on that convention. So this is now an attribute of a ledger, but in previous releases like 11i, this was not really attribute of the ledger, but it was still there in the picture, and you will define the convention at the subledger configuration. So now that's why in release 12 we say we have 4 C's associated with the ledger. 4 C's meaning chart of account structure, currency, calendar, and convention. So in real short, whenever you are designing your ledgers, you take a look at the 4 C's associated with all the companies in the picture. So if you have 5 companies to implement, first thing you look at is, are all the 5 companies following the same 4 C's? Then you can put them in the same ledger. Fifth thing you look at is the ledger options, which are basically attributes you define at the ledger level, like for example which retain earning accounts to use, which suspense account to use, and so on. If all the 5 companies can afford to have the same ledger options, then you can put them in the same ledger. But the 4 C's have to match for all the companies going in the ledger. For example, you have 5 companies, one of them has a functional currency of US dollars and the other 4 have functional currencies of Canadian dollar, then that one company is going in a different ledger for sure. We don't have a choice. So in release 12, what happens is we have a subledger accounting module in the middle. All the accounting events that are being generated from different subledger modules are sent to the SLA module, and this SLA module, based on the accounting convention, generates accounting, and this accounting is then sent to the GL module. The GL module receives accounting entries from all the other modules, and you can also enter accounting directly into GL as well. Why all the accounting is going into GL? For one good reason: reporting will be run from general ledger module, and the reports, financial reports, will display all these numbers. So here is the important point. The data in general ledger module is segregated by ledgers. Data in ledger 1 is not visible from ledger 2, and so on. And data in all these subledgers is segregated not by ledgers but by operating units. So invoices that you enter in payables go in a certain operating unit. So invoices sitting in operating unit 1 are not visible from operating unit 2, and so on. And similarly, transactions that you enter in receivables go in operating unit, and requisitions and purchase orders that you enter in purchasing module go in operating unit, and sales order that you enter in order management module go in operating unit. And similarly, in cash management module, the data that you enter for bank statements go in operating unit. So data in operating unit 1 is not visible from operating unit 2. Related data within operating unit 1 is available. For example, invoices belonging to payables module that are sitting in operating unit 1 could be netted against transactions that are sitting in operating unit 1 belonging to the receivables module. We have a netting functionality in Oracle applications, so invoices within operating unit 1 could be netted against transactions within operating unit 1. Similarly, requisitions in purchasing module within operating unit 1 could be added to the purchase orders within operating unit 1. So requisitions sitting in operating unit 2 will not be available for the creation of purchase order in operating unit 1. So the bottom line is that there is a hard line of partition between operating units. So that's why we say data is segregated by operating units in the subledgers. So if you have two operating units and you have all these subledgers up and running, so it's like as if you have two separate installations of Oracle. So data in one operating unit is not available to the second operating unit. However, two operating units could be connected to the same ledger. Not only that, a ledger could have multiple legal entities within it. So there could be more than one operating unit serving one legal entity. And legal entity could be one balancing segment value, or it could be multiple balancing segment values. It doesn't matter. You can have an operating unit serving one legal entity, or you can have two operating unit, meaning multiple operating units serving the same legal entity. In fact, you can even have one operating unit serving more than one legal entities, and this setup is not very common and sometimes it's confusing for people to understand, but Oracle does support one operating unit serving multiple legal entities as well. So I have not shown that here in the diagram to keep it simple. So keep in mind that operating units are simply bodies, group of people that are doing operations to serve one or more legal entities, okay? And two groups of people who are performing the same operation may not want to see each other's data. So that's why whenever we are deciding how many operating units to create, the first thing we look at it is, are there two different bodies of people who are performing this operation, and the term usually referred to as service centers. So if we have two different service centers, then ideally we should have two different operating units, because we don't want to mix up data between the service centers. Before we move forward, we need to refresh our memory on responsibilities. What is a responsibility in Oracle? The term responsibility in Oracle is used mainly for the concept of a role. You create various responsibilities and then you assign responsibilities to one or more users. So a user may have more than one responsibilities, and one responsibility may be shared between more than one users. Okay, so responsibility will dictate mainly three important things. Number one, what menu tree a user will see when he logs in using that responsibility. A menu is simply a group of the menu options which represent different screens, and this is how you control whether a person is seeing payable screens or receivable screen or general ledger screens. And broadly we can say, okay, a person is now logged into a payables module. You can mix and match all those screens. You can even create your own menu tree where half of the menu items are pointing to payables screen and rest of them are pointing to receivable screen. So a module is a very loose term in this context. So that's why menu tree is more of the right term that dictates what kind of functions users have access to, and that's how you control the function security, meaning what kind of screens user can access when he's connected to that responsibility. The second thing responsibility controls is what reports user could run, and we group the reports together in a container called request set, and we attach the request set to the responsibility. So if I have two people who should have access to the same screens, but one person will be running 10 reports and the other person should only be able to run 5 of these reports, then I have to create two responsibilities, and I will attach the same menu to both of those responsibilities, but I will attach different request set to each of those responsibilities. One request set giving access to 10 reports and the other one giving access to 5 reports. This is how you control which group of users could run which reports. And finally, the responsibility also controls the data security. Okay, we understand the menu controls which screens users have access to, but let's say a user could go into a journal entry screen. After going into the journal entry screen, could this user see data for company 1 or for both company 1 and company 2? And that is controlled by the data security. So a responsibility is associated with the ledgers and also with the operating units. So if it is a general ledger related responsibility, then mainly you have to see to which ledger this responsibility is pointing to, and the person could only see data for that ledger that this responsibility is pointing to. So this is really high level, but you can also control within that ledger, this person could see data for which of the companies. So let's say if we have 3 companies in that ledger, you can control whether the person accessing the system through this responsibility could view all the 3 companies or just company 1 or 2. So the most important thing is you control which ledgers data this person will be seeing if he goes into, let's say, journal entry screen. And if you're talking about some subledger related responsibility like payables and receivables, then your responsibility will control which operating units data you'll be seeing when you go into, for example, invoices screen. Operating unit 1 may have 10 invoices sitting in it, operating unit 2 may have 100 invoices sitting in it. So based on to which your operating unit your responsibility is associated with, you will be seeing either 10 invoices or 100 invoices. So we marry a responsibility in Oracle with operating units and ledgers using a feature called profile options. They are like environment related variables, you can consider them as, and you set different values to these variables at responsibility level or at the site level or the application level and so on. So the bottom line is that there will be a certain value associated with different profile options at each responsibility level, and that will dictate to which ledger or operating unit this responsibility is pointing to. So the profile option that is used to marry a responsibility with a ledger is called GL data access set. Access set is a separate entity than a ledger, and I'll talk about that in a bit. So there will be a data access set representing your ledger, and you simply connect that to your responsibility. So that's how system knows that whoever connects to responsibility 1 should be able to view the data in ledger 1, not in ledger 2, and whoever is connected using responsibility 2 should be able to view data sitting in ledger 2. So whenever you create a ledger in the system creates a data access set by the same name. So you always have one data access set available in the system for each ledger, but there may be scenario where you want to group more than one ledgers in one data access set, and that scenario would be, for example, there is a third group of users who wants to have access to both the ledgers using one responsibility. Other option was you could have given this group both responsibilities 1 and 2, but then they have to switch back and forth between responsibility 1 and 2. So whenever they want to view journals in ledger 1, they would go in responsibility 1, and whenever they want to view activity in ledger 2, they will switch back to responsibility 2. That is not very convenient if somebody wants to have access to both the ledgers. So in this case, you will create a special responsibility 3, and you will only give this to those people who wants to have access to both the ledgers. Then what happens is in the system, there's a pick list appears on most screen for the ledger, and instead of switching responsibilities back and forth, you can go into that pick list and simply change the ledger in that pick list, and the data then start appearing for that ledger. So that way you don't have to switch responsibilities back and forth. So data access set is a container of ledgers, so you can create your own data access set and you can put multiple ledgers in that data access set. There is certain restriction. You can only put those ledgers together in one data access set that follow the same chart of account structure and calendar, etc. But you can group ledgers together, and then you can assign the data access set to the certain responsibility, and whoever has this responsibility will get access to multiple ledgers. So this is how we do it in GL. And what if we have a similar requirement at the subledger level? So this is where MOAC comes into the picture, multiple organization access control. So let's talk about a basic scenario first. Let's say you have two operating units, operating unit 1 and operating unit 2, and you have two group of users. One only wants to do activity in operating unit 1. So you can create a responsibility and you can point this responsibility to operating unit 1. And how do you do that? We have a similar profile option just like how you saw in case of ledgers, and this is called MO operating unit. MO stands for multiple organizations. And using this profile option, you marry your responsibility to certain operating units. Then whoever is connected to the responsibility will see the data in that operating unit. So in this scenario, we have two responsibilities, 1 and 2, one married to operating unit 1 and the other one is married to operating unit 2. The whole idea of creating two different operating units was that so that we could keep the data separate, and most likely there are two different groups of people who want to connect to these operating units. So that's why we created the two operating units to begin with. But there might be a scenario where you have a special group of users who want to have access to both the operating units through a single responsibility. If we are unable to provide them a single responsibility giving them access to both the operating units, then what this group will end up doing is they will be ending up switching responsibilities back and forth. We could give this special group both the responsibilities, responsibility 1 pointing to operating unit 1 and responsibility 2 pointing to operating unit 2. Then this group will be doing back and forth, and that is time consuming. So we could create a special responsibility and we can group all these operating units together in a container, and this time container is called security profile. Similar to a data access set that holds multiple ledgers, security profile holds multiple operating units. So you can see one difference between how we handle the same scenario in general ledger module and how we handle that in subledger modules like payables, receivables, and so on. In general ledger module, we only have one profile option controlling how many ledgers you see through the responsibility, and that was GL data access set. And whenever you create a ledger, one data access set is created for that ledger, and you can use that to assign it to a responsibility. But if you have a complex scenario, you can create a custom data access set and put multiple ledgers in that, and you can assign that custom data access set to the responsibility. But in case of subledgers, we have a profile option called MO operating unit, and this is used whenever you want to have access to one operating unit. And if you want to have access to multiple operating units through a single responsibility, then you are not going to touch MO operating unit profile option. Instead, you will be using MO security profile option. So we have two profile options now playing role. One will be used in case you have one responsibility pointing to one operating unit, and the other one will be used for those responsibilities that will be pointing to multiple operating units. And this is a common error people do. They put values for both the profile options and then they end up in a very unexpected scenario. So while we have a security profile playing a role of giving access to multiple operating units through a single responsibility, you can also take advantage of yet a third profile option called MO default operating unit. So this profile option will control which of these operating units will appear as a default when you go to certain screens, and then you will have the option of changing the operating unit from the default to some other operating unit using the pick list, but one of them will be chosen as a default using this profile option. And this default could be set to different values for different users. Keep in mind, profile options could be controlled at responsibility level and also at user level. So user A will have a certain default, user B will have certain default, and both, since are connected to the same responsibility, both the users have access to operating unit 1 and operating unit 2. So the bottom line is that multiple organizations access control is a feature of Oracle that lets you use one responsibility to have access to multiple operating units. When we say access, we are talking about transaction screens, setup screens, and reports. So without switching responsibilities, you can go to a transaction screen and you will have a pick list available to choose operating unit from, and based on whatever operating unit you choose, you will see transactional data for that operating unit, and same thing will be applicable to setup screens. You can go to a certain setup screen and you can see the setup of different operating units without switching responsibilities back and forth. And when you run reports, you have a parameter for operating unit and you can control for which operating unit you are running report, and there are certain reports that you could run for multiple operating units as well.